Initial coin offerings are faster fundraising tools, but STOs offer legal clarity that many institutional investors now demand. The useful question is not which label sounds better. It is what kind of capital a project needs, from whom, and on what timeline. The confirmed event is that the comparison frames ICOs as faster and more retail accessible, while STOs are slower, costlier, and more legally structured. The reason this belongs in a crypto news read is that token fundraising has changed as regulators draw clearer lines between utility tokens, securities, and investment contracts. The opening pressure point is token fundraising has split paths against speed versus legal durability. The first confirmed detail is ICOs tend to be faster and cheaper, and the immediate reason to care is that STOs are explicitly regulated securities. That means the viewer should track classification rules and venue depth instead of treating the first reaction as the whole story. The confirmed context is the anchor. The confirmed baseline is that ICOs typically sell utility tokens, while STOs explicitly issue regulated securities. STOs can involve equity, debt, revenue rights, or asset claims, while many ICO tokens do not provide legal ownership. It gives the story its boundaries, which is especially important when the market starts filling gaps with assumptions. The two facts that set the baseline are clear. ICO tokens often lack ownership rights, and STOs can carry equity or debt claims. That frame keeps ICOs and STOs sell different rights connected to the actual consequence rather than floating as an isolated statistic. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Initial coin offerings only make sense once the mechanism is clear. The mechanism is legal classification. Investor rights and regulatory obligations depend on what the token represents. Marketing language, buyer expectations, and issuer promises can affect whether a token is treated as an investment contract. That mechanism explains why the event can create consequences beyond the first reaction. In practice, token rights drive regulation is the hinge between the confirmed event and the next market or user response. The mechanism split is simple. Token rights shape legal treatment, while promises can affect classification. If that hinge fails, the strongest title-level claim loses force, even if the story keeps attracting attention. The practical effect is not evenly spread. Founders, retail buyers, accredited investors, regulators, exchanges, and real-world asset issuers are affected. The practical consequence is that ICOs may move faster but carry more enforcement risk, while STOs trade speed for durability. Hybrid models can separate company equity from later utility token access, but they still need careful structuring. The useful boundary is that founders trade access for compliance, while future taxonomy remains open. The impact split is retail reach favors ICOs and institutional credibility favors STOs. That keeps the impact focused on the people, markets, or systems actually named in the evidence. The open question is still part of the story. What remains unclear is how future token taxonomies and safe harbor rules will reshape the boundary. That does not prove that either ICOs or STOs are always better for every raise. The evidence would be stronger with jurisdiction, investor type, token rights, timeline, and counsel review would clarify the path. This is the line between analysis and speculation. The unresolved split is neither structure wins every case and jurisdiction, and investor type decide fit. The story can stay important while future taxonomy remains unresolved, but the stronger claim needs visible proof. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The next useful signal is specific. Watch new token classification rules, enforcement actions, and regulated security token venue liquidity. If clearer taxonomy rules reduce ambiguity for new raises, the story shifts from fundraising choice into rule clarity. For initial coin offerings, the next move should be judged by that signal. The trigger split is new taxonomy rules are the next signal, and security token liquidity also matters. If that trigger does not arrive, the story may stay in fundraising choice longer than early attention suggests. If it does arrive, rule clarity becomes easier to evaluate with facts instead of assumptions.